The global stock rally stalled as investors weighed the potential impact of upcoming U.S. inflation data while parsing a flood of mostly positive earnings reports. Let's get more on this from John Burrello, Senior Portfolio Manager of the Global Strategies team at Invesco. John, thanks very much for joining us today.
Thanks for having me.
What is it? Seems like we have a mix of everything going on.
A lot of uncertainty in the markets today. I mean, if you look at U.S. stocks, for instance, we just talked about some of the earnings that we're seeing coming out. We're in the thick of earnings season at the moment. You know, I think one of the notable items when we think about uncertainty, last quarter was a 16-year high in terms of single-day moves for names that were reporting earnings. Mm-hmm. They were moving about 5% on average. I think we're seeing the similar pattern now, where earnings are really causing stocks to move quite a bit. And that's creating, again, more volatility in the markets. There's a lot of reasons for people to be thinking about volatility. I think that's driving people to think about risk management as well.
So what are your big concerns then when it comes to volatility?
Yeah, I mean, I think if you look at market concentration, for instance, I know that's a topic that's been around for, the last year or two, but the Magnificent Seven driving not just U.S. stocks, but global stocks higher. And it's really just a few stocks that we're now becoming more and more dependent on in terms of, market movement and the volatility of the markets. And so we're looking at ways for people to reduce that concentration. We have, in our case, we're managing option income portfolios that can help take that risk out with an equal weight S&P 500 exposure, for instance, as a way to kind of reduce some of that concentration risk. So that's definitely one of the items. Another is just valuations. We all know it's been a great time for stocks.
Yeah.
And if you look at some measures, free cash flow yields, for instance, they're lower than government debt yields. And so that is kind of pointing to stretched valuations as well. So a lot of reasons to be enthusiastic about markets,
Yep.
But also again, risk management is key.
And how are you balancing all that? Where's your eggs going?
Yeah. Well, so I think, when we look at our client base, what we're hearing from our clients is that basically they're either concerned that the markets have already had a massive run and they're looking for ways to take chips off the table because of things like valuation and concentration,
mm-hmm.
or they've been on the sidelines and it doesn't feel like the right time to kind of jump in with both feet, right? And so, using strategies that are options-based is a good way to complement other sources of defense. For instance, traditionally, people would use bonds maybe as a way to kind of dampen equity risk. But that really comes with a correlation bet. In other words, you're looking for bonds to go up when stocks go down.
Mm-hmm.
With option-based strategies, you don't have to have that correlation assumption. You've got protection baked right into the portfolio, so that you can reduce risk, but still stay invested. So when my team looks at this problem of, well, how do you stay invested in stocks? Because we know that's a good thing over the long run. It's balancing the participation you get, the defensiveness, but then also adding some income into portfolios.
And does it feel like we're into bubble territory for for the Mag 7 and the tech sector?
Look, it's certainly frothy. I'm not going to use the B word, but I think people need to realize that stock markets don't always hit home runs like George Springer. So it's one of those things where you want to take some risk off the table and prepare for maybe more subdued returns in the future, because we don't really know how some of these stretched valuations are going to play out, how much more is left in the tank. So again, risk management I think is really important.
Which are better than losses, right? Smaller returns are always better than losses. Where are you looking beyond them? Are you looking beyond the U.S., beyond North America?
Yeah, so I think global equity portfolios, we manage, for instance, a global equity income advantage strategy that's designed to have that full diversification across the world, to try to reduce that reliance on large kind of AI-driven enthusiasm in the markets. So I think regional diversification is also really helpful. We look at it as take your U.S. Equity exposures, add risk management again through an option income type of portfolio, or have the global strategy that has that more broad diversification associated with it.
There are other markets that have outperformed the U.S.
Absolutely. Yeah, I mean, so we've seen markets like MSCI EFA, if you look at developed international, or Europe, of course, really driving markets higher. And that's been, of course, in the face of a lot of the uncertainty that we're seeing across tariffs and some of the geopolicy noise that we've seen this year. So sure, outside of the U.S., definitely really big opportunities there for investors as well.
And the tariff war, what kind of an impact is that having on the decisions you're making?
I think, again, that just adds more uncertainty to it.
Too.
Yeah, and it's been, every tweet, it seems like we've got a new direction that the market could go based on what's happening with tariffs. But, April, of course, was a very large bout of volatility associated with that. Then I think we've had a very nice rally because it wasn't as bad as feared. And then, now we've got U.S. and China relations, again, up in the air. So, this is another reason, again, we don't know, we can't predict what's going to happen with tariffs, but we can prepare. And we can do that, again, with adding conservative option-based overlays onto our strategies. I mentioned global equity income advantage. We also manage exposure to the NASDAQ 100 with our QQCI ETF, and then S&P EcoWeight with EQLI as ways to stay invested, but take some of the chips off the table, manage through that volatility.